and we will make a start. My name's Brendan Council. I'll be the chair for this session today. Today we've got two presentations. So the concurrent sessions will run, we'll have two presentations, one after the other. The presentations will go for approximately 20 minutes each, with 10 minutes for questions on the specific presentation. And then we've got some time for group Q&A at the end. So I will introduce the speaker for our first presentation for the first 30 minutes of this session. Our speaker is Sylvia Pleskot. So Sylvia Pleskot is a fellow of the Institute of Actuaries of Australia. She's the head of business development for Swiss Re and Asia across both life and health and P&C. She's a qualified actuary with over 15 years of experience in life insurance and is currently based in Hong Kong. She has worked in a variety of strategic finance, valuation, product development and analytics roles within direct insurance and reinsurance. Please join me in welcoming Sylvia to the stage.
Thank you, Brendan, and hi, everyone. I would like to start actually with some fun facts from a Forbes survey that was done a few years ago, and it surveyed a few thousand people, and it asked people, what is the most important handheld tool of all time? And I want to ask you that, like, what do you think the number one tool was? If you had to take a guess. Think now, think back to the Stone Age. That made it on there, yes, very good. Yes? Yeah, I think that was in the top 22. The wheel? Oh, I don't know if that one made it on there. But I can... Lenses. Oh, I'm not sure, but it's a good try, yes. So the number one tool was actually a knife. But what was quite surprising about that what was quite surprising about the list is there were tools that made it on there that didn't even cross my mind. And maybe you guys can't see this from the back, but this is a fish hook. I'm holding a fish hook here. That actually made it into top 20. And that definitely did not cross my mind. What I'm here to talk about is just like the fish hook, reinsurance. It's not the thing that first comes to mind when managing financial market risk, but it can be certainly quite impactful. And today I want to talk to you about how you can use reinsurance to manage financial market risk and to improve ROE and reduce profit volatility. Now, the way I would like to structure the presentation is just to share a little about the trends that we're seeing in Asia, and then spend most of the time on two case studies. And for those of you who are already familiar on this topic, I hope I'll be able to offer some new insights through the case studies. So why is so much attention placed on this topic, at least from where I see looking out into Asia? The reason there is that much attention is if you look at the breakdown of insurers' capital, which they hold, what you can see in this graph is that a big proportion of their capital is held in relation to asset or financial market risk, and that you can see that in the blue. While in the red, you can see the amount of capital held for against insurance risk. And that's looking at countries such as Australia, Japan, Singapore, Hong Kong, and China. So you can safely say that more than 60% of capital held is in relation to asset risk. Now, if I look at the breakdown of that blue section in terms of the components of asset risk, a big proportion of that is held in equities, and that's because there are a lot of participating savings products sold in Asia. Then a fair bit is held in relation to credit risk, which is there in the light purple, and then some is also held to manage interest rate risk, and that you can see that in the orange, particularly in China. Now, insurers broadly have three tools to manage this risk. The first being ALM strategy, so investing the assets to match the liabilities. The second tool being product development, so moving products to shift the risk to policyholders, so developing more unit-linked products, more protection products. And lastly, through in-force management, including reinsurance. And that's what I want to focus on today. And we're seeing a large trend towards using reinsurance. If I look at the deals, reinsurance deals done in Asia over the last 4 years, since one of the first deals done in Japan, since then there's been more than $20 billion USD of reinsurance transactions publicly announced. And that's just a public figure. In actual fact, there's been a lot more reinsurance deals done. These reinsurance deals have been motivated by insurers seeking yield upside and managing financial market risk. The major markets where a lot of activity has been taking place includes Japan, Hong Kong. They're by far the two big markets, but it's also seen more activity in Singapore and emerging interest in Korea. Just to list a few of the transactions, just a few of that have been done in the last 12 months. Most recently, Couvert, so it's a Bermudian reinsurer, announced the two flow transactions, new business transactions in Japan. Resolution Life have also done a big transaction with Dai-ichi. Fortitude Re have done a big transaction with Taiyo Life. And that's all in the last 12 months in Japan. In Hong Kong, Couvert have also announced a big transaction on an in-force block with a multinational insurer. And then back in 2021, AXA did a big, just under $5 billion deal with Global Atlantic and RGA. So there's been a lot of activity. And what you can see here is that there are some traditional names that are participating in these deals. These traditional names include Swiss Re, but they also include RGA, but also some of the non-traditional names that are emerging in the reinsurance space. Some of the ones that I've mentioned, so these Bermudian-based reinsurers are appearing. The other motivation around transactions that have been occurring is to help with ALM matching, particularly with interest rate volatility. And in this space, there's also, you can see China on that list, and it's actually a market where Swiss Re successfully executed a transaction to help manage interest rate volatility. But these types of transactions are also happening in the other markets as well. So the two ways that primaries use reinsurance to manage financial market risk are shown up here, and I want to use the metaphor of the brick and the brick wall. So the first way is through embedding derivatives into a reinsurance structure. Now, the reason I've used the brick is because that's a very specific component of the whole. Usually the reinsurance structure aims to has some other objectives. The derivative is embedded within that reinsurance structure to generally manage hedgeable financial market risk. And the benefits it has to the insurer is to reduce profit volatility. The second way to manage financial market risk through reinsurance is through coinsurance. And there you can see the brick wall. That's because through coinsurance, it's a holistic solution. It's the transfer of liabilities as well as all the assets. So with that, the investment risk is also transferred to the reinsurer. And these reinsurers tend to be asset-specialized reinsurers that will have some form of advantage in the way they invest the assets, and therefore can pass some of that benefit back to the primaries. Looking at the first example of a derivative a lot of our clients ask us, why should we consider embedding a derivative into a reinsurance contract when we have the capabilities of executing that ourselves? So there are actually three main benefits of considering embedding a derivative within reinsurance to manage that hedgeable market risk. And the first, I would say probably the most compelling one, is that it can be very capital effective. And that's in particular if an insurer of a primary is exploring to develop a new product or maybe enter a new market, and they don't want to develop those capabilities until they are certain that that product is going to be successful. It may be more efficient to engage a reinsurer to manage the ALM risk. And generally, this will be embedded as part of an overall reinsurance solution that will have other additional capital benefits. The second reason why embedded within reinsurance is that there could be accounting restrictions. And this will be the case of one of the case studies, the first case studies I go through. So there may be accounting restrictions that the primary faces on the use of derivatives or very onerous reporting requirements, therefore making it more efficient to transfer that risk to the reinsurer. And lastly, transferring the risk to the reinsurer may overcome some internal restrictions, such as restrictions on the risk limits or overcome any sort of lack of sort of gaps in capability. Now, just before going into the case studies, I just wanted to show that, I mean, reinsurance comes in a lot of different flavors, but the two flavors that are most relevant for managing financial market risk are vanilla coinsurance and then basic funds withheld coinsurance. And the fundamental difference between the two is around who retains the assets. So with vanilla coinsurance, the assets are transferred to the reinsurer as well as all the liabilities, while generally with the basic funds withheld coinsurance, the primary chooses to retain their assets but may want to transfer some components of the investment risk. And that's generally when the primary believes that they may have an advantage in the way they invest their assets, but still want some sort of help with the investment risk. So jumping into the first case study here. So the background is that this was executed in China by us with a primary. The primary's motivation was to reduce economic profit volatility. In particular, they wanted to reduce the risk of interest rates moving further down. The portfolio in scope was a long duration, whole of life portfolio that's typical in China. And there were the reason that this solution was quite appealing to the primary through reinsurance is that there were accounting restrictions on the use of derivatives. So the reinsurance could overcome that through an offshore reinsurance structure. The solution involved a funds withheld reinsurance structure, so the primary retained the assets. They were happy in terms of how the assets were invested, but they were seeking that protection on the interest rate downside risk. So essentially, that was quite a straightforward derivative, converting the floating interest rate into a fixed interest rate embedded within the reinsurance structure. There was also transfer of insurance and lapse risk to make sure that the structure passed sufficient risk transfer tests. There was a collateral account set up to help manage the counterparty credit risk, and that counterparty credit risk exists for both parties, both the primary and the reinsurer. And that would not be too dissimilar from that would be set up if the primary executed a derivative with a bank, but there may be additional flexibility in terms of how that collateral could be arranged if it's with a reinsurer. Now, the benefit to the primary was a reduced profit volatility and then the transfer of execution risk of the derivative to the reinsurer. In terms of other considerations, these structures are very effective when there are financial instruments to manage the risk, so they're very effective for hedgeable market risk. So in this case, it was converting the floating to fixed interest rate. So there's got to be financial instruments available for the reinsurer to be able to hedge that risk. And the other consideration is just regulatory involvement. Often these structures are quite bespoke, and it's important to get regulatory involvement early on, especially if the primary would like to recognise solvency relief. So in this case, the motivation was around economic risk transfer, and the primary chose to execute while still in discussions with the regulator around the solvency relief. But so if I jump to the second case study, this is a case study that would be typically seen of deals that are reinsurance deals that are being done in Japan, where some of the Bermudian names that Fortitude Re's, Kuvare's, Resolution Life's, that is specialised in sort of asset-intensive reinsurance. What's probably not so typical is that you see that there might be two reinsurers involved, and I'll explain that in a little bit. So the background here is the motivation that the primary is generally seeking is to improve their ROE and reduce profit volatility, whilst also seeking yield upside. That yield and that will come through also through reduced capital held. They will typically work with an asset specialized reinsurer that can have a more that can invest the assets in a more higher yielding investment strategy and pass on some of those benefits back to the primary, typically through sort of the capital requirement, well, through essentially regulatory arbitrage that would happen depending on where that asset specialized reinsurer is based. So most of these asset specialized insurers are based in Bermuda, and there is a degree of regulatory arbitrage that can happen in terms of around the investment strategies. The typical portfolio is a whole of life portfolio. It can be done, these deals can be done on in-force, but also as well as on new business. The solution is a coinsurance solution with the full transfer of assets and liabilities. That includes the transfer of the investment risk. The reinsurer will be able, it generally specializes in these high yielding strategies and may work with a traditional reinsurer such as Swiss Re, particularly to make the overall deal much more appealing to the primary. What the traditional reinsurer may do is provide greater competitiveness on the insurance or the lapse risks, while the asset specialized insurer generally can focus more on the investment side of this deal. So there can be two reinsurers involved. The benefits to the primary include improved ROE, reduced profit volatility, but it can come at a cost where the primary may need to crystallize whatever investment losses they hold at the time of execution. Other components, other considerations Counterparty credit risk, that's a big one. Essentially, what these structures involve is the transfer of insurance and investment risk into credit risk. So hence, setting up the right collateral arrangements is quite important. And these collateral arrangements tend to be quite bespoke. And of course, regulatory involvement in these deals is really important, as these deals tend to rely on capital being moved offshore. Hence, the regulator would need to be closely engaged and to approve. I thought I'd touch a little bit on Bermuda as to why so many of these names are emerging out of Bermuda. And it is essentially, there is a degree of regulatory arbitrage that can happen. I mean, Bermuda does offer Solvency II equivalent, which does make it quite an attractive regulatory regime. It does allow investing in higher yielding, possibly less liquid assets, as long as the reinsurers can sufficiently prove that they are ALM matched. They're able to recognise a matching adjustment and discount the liabilities, therefore, respectively, at higher rates. And hence, a lot of these names emerging are based in the reinsurance space are based in Bermuda. So to summarise, you've just heard me talk about the fishhook of reinsurance to manage financial market risk. The key benefits of doing this, of using reinsurance to manage financial market risk, are to reduce profit volatility and to improve ROE. The two main ways how it's done is either through embedding derivatives into the reinsurance structure or through coinsurance, so the brick and the brick wall. And the portfolios to which it can be applied for, it can be in force or also a new business. And what I just want to briefly end on, if Swiss Re has a suite of capital solutions, and we always start with the client need in mind. So if any of these case studies resonated, or if you have any other sort of questions around capital and reinsurance solutions for capital, please do not hesitate to reach out to myself or to any of your local Swiss Re colleagues. Thank you.
Thanks, Sylvia. Is this that microphone? Yep. So thanks, Sylvia, for a very interesting presentation. So we now do have about 10 minutes for questions. If you would like to ask a question, I'm not sure if we've got a roving mic, but please feel free to stand up and ask your question, or you can put it into the app. So hopefully you're familiar with the app now. You just go to the Now On section in the app, and we're in Concurrent Block 1, Room H, and then you can type Ask Questions. So if you would like to ask a question through that platform, please do, and we'll pick them up at the front here. But yeah, for the extroverts among us, please also feel free to ask a question into the mic. Perhaps we've got one over there. And sorry, if I could just maybe ask just to state your name before you, for any questions, please. Yeah.
Okay, I'm Jari Niittumpera, and I'm from the Finnish Supervisory Authority. And thank you for this presentation. So what we are looking at currently is, we admit that there is some kind of risk mitigation effect. But when looking at the mitigation effect in solvency calculations, we are a little bit dubious. Our position is that the companies have overvalued the risk mitigation effect. We are looking at the reinsurance treaties, and there are a lot of limitations. And one of the essential ones is that currently this is based on value, especially we are looking at lapse reinsurance currently. So this is valued by value in force, and it should be immediate loss of value in force. And in the treaties, there is always calculation of 1 year, so there's load also before that claim. And another thing is that the lapsation is not actually, it is not linear, though we have seen that some companies consider that the risk mitigation effect is linear. And this is, if we consider the lapsation in relation to the amount of lapses, so in a year there are less amount of lapses typically, and when covering this higher amount, that is less risky. So when considering this, so what is your position as a reinsurer, how the companies should calculate their risk mitigation effect? Currently it seems that as we have analyzed, it seems that they have overestimated the risk mitigation effect. And there actually is a position paper on EIOPA, that is EIOPA is the common insurance the supervisory authority in Europe, if you not know everybody here. So they have also a position paper, but this is in more general level. Thanks.
Thank you. It's a very complex question, but I think just to make sure I understand and boil it down to essentially how to deal with lapse risk within these type of solutions.
In company level, in the cedent level, not really.
In the cedents, at the cedents level, yeah. I have to say I might not be in the best position to answer that. Just what we generally see with many of these deals is that they tend to be lapse supported. So generally, if lapses go, generally it's profitable for the companies if the lapses go up. And I mean that in itself creates some challenges when also developing new products. But certainly, I mean, what I can share is from a reinsurance perspective, we also try and analyze dynamic lapse behavior. So we tend to link lapse behavior to, in these savings type portfolios, to movement in the interest rates, and we'll run some stresses around that. So where interest rates will move up, it's likely that there may be more lapses as policyholders may want to switch into other products.
Okay. Another question at the back there.
Thank you. Interesting paper. Sunil Sharma from Kotak Life Insurance India. I just want to know, the two case studies that you've shown, case 1 and case 2, which of the markets, are they from, apart from this, what are the various markets, wherein such solutions have been implemented? The third thing that I was thinking from the direct insurance company's perspective is that I understand that this country, in particular this market, has become the reinsurance hub because perhaps the market is more reinsurance friendly, lower capital requirements, etc. How do you see it from the direct insurance company's perspective? Lower capital requirements would mean the low security for a direct insurance company.
Thank you. So let me start with the first part of the question in terms of which markets these case studies are applicable for. So the first case study being around the use of derivatives within reinsurance. That can be executed actually in any market where there's a liquid enough sort of market for the risk that the insurer is seeking to manage. So in most cases, it is around interest rate risk. So as long as there's interest rate futures or bond forwards that exist, that can actually be done in any market. But then it comes back to needs. So that case study was in China. We have done similar sort of structures for Hong Kong, but could theoretically execute it. I think even could theoretically execute in most markets. The second case study, where it's the transfer, like the coinsurance, where the transfer of assets to this asset, generally an asset specialized reinsurer. Right now, these deals are happening in Japan and Hong Kong, and it's largely because of the regulators there are just more open to exploring or being more open towards these structures. I think there would be interest for these deals to be executed in Korea, in Taiwan, and in other markets. I know there'd probably be interested in China as well, but it comes down to the regulators. And what you're saying is very true. That I mean, essentially, from an insurer's point of view, you've transferred insurance risk and investment risk into credit risk, and you've sort of in that process, the insurer would have received some capital efficiency, especially in these asset transfer deals. The way that risk is being managed is through setting up fairly robust collateral agreements between the insurer and the asset specialized reinsurer. And these are generally quite bespoke arrangements. Because these reinsurers, these asset specialized reinsurers tend to want to invest in less liquid, high yielding assets, that becomes a negotiation around collateral. Like it's probably not market value collateral, it's probably something closer to book value. And then that negotiation happens to give that, to manage that risk.
So these specialized reinsurers, who kind of asset experts, do they really hold those assets? For example, for the interest rate risks, obviously the writers of such derivatives would really buy those assets so that the future interest rate could be managed. So that, or they just remain rack and naked.
So I'm actually not familiar with the exact investment strategies of these asset specialized reinsurers, but I do know we have some people in the audience here who may provide greater insights than myself, because essentially, I mean, that's their secret sauce in terms of how they're able to provide higher yields. But I would welcome anyone from the audience to answer that question.
Hello. If you want to meet one, here you go, Resolution Life. I think a couple of elements here, right? It's all about LLM. And I appreciate you distinguish us from, assets and yield versus traditional reinsurers, but we're all about risk transfer. There's no difference, in fact. LLM is in the heart of what everybody does. It's just they have different asset strategies, and that asset strategy will drive their value add to everybody, right? So the value add can come from yield. It can come from currency management. So a lot of that is in USD, but some are local currencies. So you fix your currency issues as well. But really importantly, I think it was gentlemen about a lapse risk. risk transfer on lapse and dynamic risk transfer as well, like dynamic lapse with interest rate movement is transferred as well. So it's all risk transfer. Right? So I'm here standing here as a Bermuda, no different to a traditional reinsurer like Swiss Re. It's all about all risk transfer, and we really prefer that. It's the best one. Regulators love it, I think. We can just stand up and say all risk transferred, everything. But I think you're right, credit risk, yeah. So it's up to every company's risk tolerance and to accept credit risk. Thank you. No, thanks, Sylvia. Very good, thank you.
Thanks, Jan.
Okay, I'm going to finish it there. So if you could just put your hands together for Sylvia. I thought that was really well done, Sylvia. Thank you.